Hey, we're here with March's edition of the best stocks to buy. Every month I like to put together a video guide discussing anywhere from 3 to 5 stocks that I think make really good buying opportunities due to either long consolidation periods or just recent pullbacks. I'm also going to follow up on last month's picks because some of those are still good buys as well. So the first company I really like is Starbucks. They're still down 3.5% year to date, although they are up 3% from my post 2 days ago. I made a post Tuesday before the open discussing Starbucks and how I really liked it and thought it was a good buy at the current price. And it happened to open that very day up 1.5%, and it's been up a little bit ever since. So it might come down a little bit. You might get it 3% down, but know that it's still down 8% off its 52-week high, so it's still good value. And even if it was trading at its 52-week high, the bottom line is that Starbucks is a great company with great leadership, has a lot of good growth opportunities. They're very strong in e-commerce, and they have the whole Teavana brand that they're building out and have a lot of room for expansion there. And I also like the fact that they've managed to post a decent quarter in spite of really bad weather in the United States. Most other retail places reported major disappointments. Starbucks actually came out okay. Wasn't a great quarter, but the fact that it wasn't negative like a lot of the other places was a very encouraging sign, we'll say. So the next company I really like right now is PepsiCo. It's a great dividend stock. It's not going to make you rich overnight, but it will produce steady returns and does have some room to move upwards. And I've liked this stock for a long time, and it just happens to be down a percentage point on a year-to-date basis. And while it is up a little bit, again, this one's up a little bit from my post 2 days ago, but it's still, a good value. And Pepsi recently fell on news that soda consumption was decreasing. And I really like Pepsi because they're sort of buoyed by their snack portfolio. They own Quaker, they own Lay's, they own Doritos, they own Ruffles. They also own Gatorade and a bunch of other similar companies. So they definitely have insulation from decreased soda consumption where their main competitor, Coca-Cola, does not have this luxury. So the third company I really like right now is Costco. They're a great company with strong leadership dedicated towards long-term growth. Kind of put them in the same boat as Starbucks there. And Costco is down almost 10% off its 52-week high. It's up 1% since I made the post, but Costco has been suffering from a little bit of price-to-earnings ratio contraction just due to some slowing revenue growth. But I don't think there's a lot of room here for much more contraction. It's already dropped a lot, and earnings are actually accelerating a little bit. Earnings grew nicely. And usually that's not a good sign for, growth stocks don't really care about earnings growth. They care about revenue growth. But Costco is kind of getting out of that growth phase, and it's becoming, they're definitely still able to grow revenue significantly. And I don't think they're going to be nearly as negatively impacted by e-commerce as, their main competitor, Walmart. Costco is definitely in a different class just because they sell sort of bulk foods that right now, at least for now, there's no good e-commerce alternative. And Costco really is just focused on the long term. They have great retention rates, and I really like what they're doing. So it's a good value right now. One stock, this is a position I have in the How to Invest HQ portfolio, which if you don't know is a public portfolio that I post on my site and I invest in every month. They've had a really prolonged pullback and consolidation period from, say, July 2013 through currently. They're down almost 26% from their 52-week highs back, in July and August. But even though they're down so much off their 52-week high, on a year-over-year basis, LinkedIn is still up 15%. So it really flew, and this stock has potential to fly in no time at all. And I don't think that it's going to be this cheap for much longer. Revenue is growing incredibly fast. And I think that, we're in the spring now. I think that through the summer we could see a nice run just like we did last year. And the reason I think that is that LinkedIn issued low guidance, and the lowest the stock ever dipped since then has been about $188 a share. It's currently $200 a share. So there's almost no downside here. LinkedIn's already said, hey, we're not expecting a good year, and the stock, barely responded. It's not, compared to current price levels, it's nowhere near its recent lows. So there's very little downside, I think, here. Yep, going the wrong way. So those are my picks for March, and I'm just going to go ahead and rehash February's picks really quickly, just revisit those, see how they've done. And the reason for that is many stocks do not change significantly on a month-over-month basis, especially in the absence of quarterly reports. Some of last month's stock picks are still good buys. I didn't want to, put them in the beginning of the presentation because I wanted to cover some new material, but I still think that a lot of these are good picks. And right now, Apple, it's very attractively priced. It is up a few percentage points from this time last month, but not a huge amount. And I'll be surprised if you bought Apple today, if Apple closes under $570 at the end of the year, I'll be very surprised. When you add that in with the dividend, you're likely looking at a 10% return. And then it's in the absence of any product launches. That's just assuming they're putting out a new iPad and iPhone at some point this year. They continue to generate seller sales and continue to buy back their stock and continue to reward shareholders with an increasing dividend. I'm expecting a dividend increase in April. That's the year mark, so I think we're going to get one there. And as a result of just the cash they're pulling in, it's going to be hard for Apple to return less than 10%. So even if we're not, it's got this huge upside of a potential product launch and potential earnings acceleration, whereas it has very little downside at this point. They're making money hand over fist. The stock's very attractively priced. It's at a very low PE. There's not much to miss out. There's not much to dislike about Apple. Now, I don't know where Apple's going to be 5 years from now. Their field changes very quickly, but for today, it's a great buy. And Amazon is another company that I picked last month, and it is up a few percentage points as well from then, but it's still attractively priced. It's still a discount of almost 10 percentage points from January 2014. And when a great company like Amazon is available at a 10% discount, I feel like you just have to take it. It's a great buy. They might not pan out in the next 2 or 3 months, but if you look at Amazon's price next year or in 3 years, it's definitely going to be higher than it is today. There's just no way around it. On a year-over-year basis, you never know. People could get scared around the stock, could drop a little bit. That happens with a growth stock. If it does, you just buy again. You average down. And then, in 5 years, granted, barring global economic collapse or war or something like that, I don't see how Amazon could not provide a huge return over a 5-year period. Okay, so Potbelly Corp, that was another one I picked last quarter. That is a stock held by the How to Invest HQ portfolio. And they had a really sour report, and they're even cheaper than last month. And even though they are a lower price than last month, and I think this is still a good buying opportunity, I expect some downside given the weather. And you should be ready to buy again if necessary. It may not turn around until as late as August, and the reason I think that is because Potbelly cited bad weather as a reason for poor performance in the last quarter of 2013. Well, the problem with that is, this year has been very poor weather as well. So the quarter they report in May, which covers January, February, March, it's likely to be negatively affected too by this weather. So definitely a downside ahead there. And Zillow, that was a company I picked last month as well. It is up a little bit, but it does fluctuate wildly in price. I took a position on this at 85.5, and I'll average down with a second purchase at 77.50. I doubt we'll see that price, but just in case we do, I'm ready to buy. And I still think this is a great long-term position, and I take a new position at 81 just because there is some fluctuation. You can definitely get in cheap. And Zillow is another one of those companies that I think that has potential to move up significantly. I put them right up there with LinkedIn. This could be a company that puts around 100% return over a couple-year period, and that's what I'm looking for. So a couple dollars here and there, it's not a big deal. But, if you can get the value buy, go ahead and take it. And Procter & Gamble's also up a few percentage points. It's no longer as attractive of a price, but it is still a great company to hold long. With the stock this stable, it's up about 2% from where I recommended it on a month-over-month basis, but that makes a big difference because this stock, even if it moves 10% in a year, that's pretty significant just because they pay a steady dividend and they steadily hike the dividend. So you don't get much growth on a year-over-year basis. With that said, I still think it's a great stock to hold. Just be patient with it. And that's it. These are some great, you have a lot of options. You go ahead and do your research. And if you're looking to get into a stock this month, there's definitely a lot of great opportunities. Go ahead and subscribe for getting this feature every month.